Welcome to the Invisible Capital Podcast with PitchBook, where we shine a light on the traditionally opaque private markets. Here are your hosts, Adley Bowden and Adam Lewis.
Welcome, everyone, to Invisible Capital, a podcast that takes a closer look at the private markets by discussing the work of PitchBook analysts and writers during the COVID-19 pandemic. I'm Adam Lewis, a private equity reporter for the PitchBook newsletter, and I'll be joined today by Adley Bowden, our head of editorial and our institutional research group, along with private equity analyst Dylan Cox. Welcome, guys.
Hello, everyone. This is Adley. Excited to be talking all things private equity today.
Adley, Adam, thanks for having me on. Excited to be here.
For today's show, we'll be discussing a recent family of reports from our private equity analyst team. If you're looking for them in our research library, they are titled COVID-19's Influence on the U.S. PE Market, Buyout Funds in Times of Crisis, Quantitative Perspectives, U.S. Private Equity During Economic Turmoil, and of course, our famous U.S. PE breakdown that comes out once a quarter. Let's start, Dylan, just by giving some background into what went into making all these reports. I'm sure it's been quite a challenge with everyone working remotely and syncing up that way, and just a time of extreme economic uncertainty.
So our team, as you know, Adam, is entirely focused on producing research about private equity, M&A, private debt, and a few other strategies. But when this COVID-19 pandemic began, I think most of our playbook for how to assess these markets really went out the window, and we had to rethink how we're going to research these markets and provide insights for our clients. And one of the main ways I think we've been able to do that is using the last couple of economic downturns to inform what we think will happen in this one.
What are a few of the biggest questions that our PE research team was trying to tackle and answer?
Some of the biggest questions, I think, are what will happen with deal flow? Will there still be leverage buyouts done in this sort of environment? Also, what happens to performance of these funds? In the last downturn, we saw 2009 and 2010 vintage buyout funds perform quite well. That's mostly because acquisition multiples are substantially lower in volatile times like this. And we also expect to see a slowdown in exits. That's something we've been focused on quite a bit, is assessing deal flow and performance. Right.
Was it as simple as just looking at all the data from the Great Recession and then applying that directly to now? Because, I don't know, there's certainly similarities, but it seems like we're in such an unprecedented time that, when you're reading quarterly earnings reports now, they're like, we don't know what the 12-month forecast, 18-month forecast is or anything else.
Yeah, you're exactly right. There are similarities and I think ideas that we can take away from the last couple of downturns. But certainly, I think most of us, and certainly I, have never seen anything quite like this. And so we're, to some extent, having to make it up as we go along. I think most of us have never seen revenue drop 50% or even drop to zero for some of these portfolio companies, which of course has knock-on effects up to the fund level for these private equity firms.
Right. So I listened in yesterday to KKR's earnings report, which was, usually earnings reports are not, at least the conference calls aren't that fascinating, but over the past couple of weeks, they actually have been quite interesting listening to how the different private equity firms are attacking this. And KKR lost $1.3 billion. And they actually had to acknowledge the loss in their earnings because they had switched to a corporation last July. But even despite that $1.3 billion loss, their main takeaway, the main takeaway that I got is they're still they want to be aggressive and look for buying opportunities right now. Is that kind of the feeling within the industry, or is that just because KKR has so much money? Or I wasn't quite sure what to make of that.
Sure. So I think the first thing to take away there is that those headline loss figures can be a bit misleading. I think most of those losses are driven by mark-to-market positions, not basically unrealized gains in KKR's portfolio. But we saw actually pretty good performance on distributable earnings, which is essentially what private equity firms use to measure cash flow to their business, and also fee-generating AUM. And so I think those private equity firms, despite the headline numbers, are very well positioned going into this downturn. You mentioned them, talking about being very aggressive in this sort of downturn, and we expect to see that across the board. We expect to see an increase in distress for control transactions. Mm-hmm. Apollo notably has completely pivoted their most recent buyout fund away from leveraged buyouts and almost entirely toward distress for control acquisitions. But it's not just distress. We expect to see an increase in growth equity rounds, so essentially cash infusions into current portfolio companies, and also pipe deals. That's private investments in public equities that really serve as a way to, from the company's point of view, they need access to financing in such a volatile time. And from the investor's point of view, they can gain equity in these businesses, usually at a discount for providing that private arrangement.
Yeah, it's funny you mentioned Apollo. They're definitely the first private equity firm that comes to mind when I think of, investing in distressed assets. I think I read a Bloomberg report a couple weeks ago that said one of their executives was quoted as saying, "This is our time to shine," which, I think a lot of people right now in the economy are just trying to hold on. So it was, interesting to hear that sort of perspective from them. When you say distress for control, is that, are we talking like hostile takeover there, or is that just trying to pump equity into a company to help them out, or how would that look? And is there any example of that recently?
So generally, when we say distress for control, that means buying the outstanding debt of a portfolio company that is in some sort of financial distress. And generally, when a company goes through bankruptcy, the capital structure can be reset. And so distressed debt holders then become equity holders in the new entity.
Dan, I'll challenge you a little bit on this sort of rosy outlook for private equity. Certainly go forward. Now's a great time to be investing the dry powder that exists, but there's a couple trillion, in the ground in these portfolio companies. Others have, hypothesized that this is a moment of reckoning. These businesses are leveraged, 6 to 8x on EBITDA. That might even be an adjusted forward-looking EBITDA. And so there's, really no wiggle room for any mistakes on the operations of these companies. How do you view, the current funds that have been investing, in particular over the last 3 years, and what the industry is going to have to work through in terms of existing holdings?
So I don't think the outlook is exceptionally rosy for current portfolio companies. That mostly applies to prospective investment opportunities. But when it comes to current portcos, you're right. We like to say that private equity is essentially a levered bet on future economic growth. And when you're highly levered and there's no economic growth, certainly tough times are ahead for those portfolio companies. But the one thing that I think is a bit different this time around is that these private equity firms and private debt firms are very well capitalized, have lots of dry powder on the sidelines, and therefore will be willing to make cash infusions into portfolio companies to keep them afloat in the meantime. Certainly, you will see some bankruptcies, and you've already seen quite a few layoffs across the economy, not just private equity-backed companies. But I do think that the industry is a bit better positioned this time than they were in the last economic downturn.
What have you seen from firms or heard from professionals around their ability to be flexible with some of that financing of portfolio companies? It's not like venture where they've got these reserves to follow on. They've got future funds that might have to go back. Has there been discussions about on some of the LPA agreements, loosening some of those restrictions around, previous funds, or what have you seen, heard on that?
Yeah, I think you'll see a lot of GPs, general partners, or the private equity firms look to extend the fund lives. So for folks listening, generally a private equity fund life cycle is about 10 years, and that can be extended to 12, 13, 14 years onward, but only with approval, usually from a majority of their LP base, of their investor base. So I'd expect to see a lot of that to happen. In other cases, we've seen a lot of talk about what are referred to as GP-led secondaries vehicles. So those are essentially special purpose vehicles that are meant to roll over assets from one fund into another, that allows the GP to reset the fund economics and can also give liquidity to select LPs that are hoping to get out of a fund that's close to the end of its life cycle.
Are there going to be opportunities for private equity firms to exit companies here in the next 3 to 6 months, or do you think that we're going to see hold times just continue to go up? Because that was already kind of the trend, right? Before this.
Exits had been dwindling for the last year or so, speaking of private equity-backed exits specifically. And I think they'll almost grind to a halt in this kind of environment. Buyers are much more likely than sellers to mark to market quickly, right? Meaning that sellers of these companies still want a price that could have been garnered 2 or 3 months ago, but buyers are expecting a bit of a COVID discount. Right. And so I think you'll see portfolio companies, the hold times for these portfolio companies lengthen, similar to what happened after the global financial crisis.
Yeah, I had a conversation a couple weeks ago with an executive at Platinum Equity, Mark Barnhill, who's a pretty charismatic, media-friendly guy, which is sometimes rare for the private equity industry. But I had a great conversation with him where he said nobody wants to buy right now and nobody wants to sell. So that was I don't know, some interesting insight, I thought, from somebody who was, and they just raised $10 billion, so they would be seemingly better positioned than most people to make some investments.
Yeah, I think he's right. It's really hard to model what happens in this sort of environment, which makes transactions difficult.
What do you think, Dylan, it's going to take to get deal flow back going? Is it going to be economic reopening? Is there some level of activity? I've seen some suggestions that until the unemployment benefits run out with the COVID kind of premium in August, the economy is effectively kind of on hold. And that some have sort of put kind of the fall winter timeline on deal flow picking back up.
So I think it mostly depends on what happens with the virus, not necessarily what happens with, say, government response to this pandemic. I think until we figure out some sort of vaccine or other approach that allows us to go about our daily lives and participate in the economy again, for everyone to participate in the economy as it was prior to the crisis or something similar, I think you'll see such a high level of uncertainty that it'll be hard to get majority transactions done. That being said, a couple of the deal types that I mentioned, pipe rounds and growth equity rounds, distress for control, you'll continue to see those trickle through even during this pandemic, largely because they can be done without completely refinancing a company.
Mm-hmm. And firms right now have enough, if they did want to carry out a big majority transaction, they do have enough money, it's seemingly, in dry capital right now. I think it's like over 1.5 trillion to maybe put more equity into a deal if they want to seal it without getting bank help.
Yeah, that's right. We do expect equity levels to increase given the difficulty of securing leveraged loans in this sort of environment. I think in the middle market and private equity, you'll see debt financing come back a bit quicker because those deals tend to be arranged by direct lending funds as opposed to banks. But in general, you're right. There is lots of dry powder on the sidelines. And so I'd expect to see, once this volatility dampens a little bit, I'd expect to see those firms with lots of dry powder have higher equity contributions and then refi the company later once debt markets come back to some level of normalcy.
Which we saw quite a bit during the GFC, a lot of equity and then later leverage. So
exactly right.
What do you think on the firm side? We've done a lot of work on the valuing of PE funds and PE stakes. GP stakes have been, a growing area within the industry. Does that trend change with all of this? I mean, it'll be interesting to see as GPs, as businesses, if there's going to be a shakeout, how do first-time fund managers get through this? Curious what your thoughts are.
So after the last economic downturn in the global financial crisis, we did see quite a few smaller GPs go under or simply just not raise another fund after the financial crisis. And we saw a handful of others be acquired by larger asset managers. And so there's been a bit of consolidation in the private equity industry over the last decade or so. We expect those larger asset managers to still have a relatively easy time fundraising this year. Those name brands that everyone knows, Apollo, KKR, Carlyle, Blackstone, etc. In some cases, they're even increasing their target fund sizes and decreasing the amount of time that they expect to be on the road. But we do expect there to be fewer spin-off funds, fewer first-time managers out in the market. I think if you don't have a pre-existing relationship with your LP base, it'll be incredibly difficult to fundraise in this environment.
We've hit investments, we've hit exits. What's the viewpoint on what we're going to see for the next 6-9 months on the fundraising trail?
Yeah, so fundraising will be dampened certainly this year, but I also think we'll see a change in the mix of funds being raised, meaning that we'll see more distressed funds, more growth equity funds, probably more GP stakes, something you mentioned earlier, Adley, and fewer plain vanilla buyout funds.
With the fundraising environment being tougher for like first-time fund managers, or if you don't have any existing relationship with LPs, will there be private equity firms that like fold up shop from this? Do we have any view on whether that could happen or not? Or would that take more of a disastrous economic climate?
I think it certainly could happen. We saw it happen after the global financial crisis. And if you're an emerging manager, maybe you're on fund 1, 2, or 3, and you have some trouble in your portfolio right now and don't have great performance, it'll certainly be difficult to go back on the fundraising trail with, say, a third or fourth quartile fund. And that's certain to happen. It's hard to say exactly who those managers will be. It's likely those that are highly levered in the sectors that have been hit hardest by this downturn, namely travel, leisure, hospitality, those sorts of things. Restaurants, retail, private equity has significant exposure, especially to restaurants and retail. And so I'm sure there will be some fund managers that close shop after this.
Yeah, scary times. You can only hedge so much if things get, so bad. As we've seen with Neiman Marcus filing for bankruptcy this past week, J. Crew, one of my favorite personal places to get t-shirts. So anyways, yeah.
I didn't know you were a J. Crew fan.
My mother used to give me Hanukkah gift cards from there growing up. So I was indoctrinated early on, but that's getting a little off topic. So
yeah, leverage is a tricky thing. It makes for great returns in bull markets, but lots of bankruptcies and difficult conversations in bear markets.
To pick up the J. Crew thread and our sartorial side of this podcast, suits, ties, getting out there, big part of private equity. It's a relationship business. How do you think that changes post this or even during? I mean, can an LP realistically make a $20-30 million commitment into a fund via Zoom and digital docs? To me, I think it's just hard, see this industry really restarting until you can get to factory floor and do your due diligence the real way and meet with people in person.
Yeah, manager diligence is famously done in person and will be difficult. But I think that's starting to change. To your point, Adley, we're all sitting here recording this podcast over Zoom. Most of my daily meetings are happening over Zoom where they hadn't before. And so I think you'll see LPs adapt. If they have a private equity allocation schedule that they're hoping to keep in place, but no one can meet in person, I think they'll find ways to make those allocations over Zoom or in some sort of socially distanced way. On a couple of the publicly traded PE firm earnings calls recently, there was talk of fundraises and commitments being made on longstanding relationships, but without an in-person meeting. So again, I think that's one thing that really favors the established incumbent managers as opposed to first-time funds.
Yeah, I think KKR yesterday said that they had raised $10 billion in April. And I was just like, that blew me away because what have the rest of us been doing in April? Staying home and only going out to get to the grocery store. So certainly an interesting time.
The name and letters KKR help. I mean, I think in April was, those were probably set in February or January. So I think, this is really going to show up in May, June, July, et cetera, numbers.
Yeah, we'll see a similar phenomenon in deal flow. 1Q deal flow was almost on track with last year. We certainly saw decreases in March, when most of us started to work from home, or when most of the US started to work from home. But I think the real decreases in deal flow will come in Q2, Q3, maybe even leak into Q4 this year.
Well, Dylan, thank you for joining us. As with many PE firms right now, we're taking a wait and see approach here at PitchBook. But as always, you can go to pitchbook.com/podcasts for the show notes and relevant materials for the topics we talked about. Until next time.